TheoTrade. This is Don Kaufman. It's November 1st, 2019, and you are watching the TheoTrade Weekend Update. So, we're through another week. Economic bombs falling on us left and right this past week. The FOMC, we even had the ECB, that's the European Central Bank, changing hands. Mario Draghi is out. Christine Lagarde is in. Lagarde is in charge. What to do with a market effectively at all-time highs when the central banks are so accommodative? That's why I kind of titled this weekend's update, Hedge, Hold, or Fold. Now, I'll make it much more clear what that kind of terminology means when we get into some of the charts, some of the trade ideas. We're going to look and say like, hey, what do you want your position to look like? Not this weekend, not tomorrow, not a week from now, but months down the road, even, a longer duration. What do you want? Okay, your net position, your net delta. For those of you that do not speak geek, delta is, hey, you want to be bullish, you want to be bearish, and regardless of what your directional bias may or may not be, we're going to discuss some techniques here in this next 20 minutes for just that, for the hedge, the hold, or the fold. The other aspect that I want to bring to your attention is number one. Last week I was calling for a transition back to volatility. Well, not a lot of people necessarily look at this, but I'm going to show you here momentarily, and you're going to see that historical volatility, that is the annualized standard deviation of past stock price movement, that on a 5-day kind of average doubled in this trading week. Yet at the same time that we're seeing considerably more historical volatility, and again, historical volatility is just actual price movement in a stock. At the same time that we're seeing that, implied volatility has once again contracted. There was something else I was calling for in last weekend's video, and that was specifically regarding the SPX. I said, don't sell options premium that were very likely to tag or even exceed the expected move. We did that effectively today. In fact, I'll show you here in just a moment. And once again, even after hitting, tagging, breaching, if you will, the expected move on the week, meaning that the options market said we would move X amount, it was like $33 and change. We moved just over $33 on the week, yet they still contracted the implied volatility again for next week. I'm telling you, this screams opportunity for those that are willing to kind of wait it out. You got to be on the buy side of premium right now. Effectively, what I'm saying is, as it pertains to the major index products, I don't want to go out and sell options premium in any of the index products, because what selling options premium is about is, hey, listen, you sell options premium, the market was supposed to move $33. Well, it didn't move $33. It moved more like $40. Where's the edge for you? There isn't any edge. There's actually an edge to the buyer of premium. And what I'm looking for, okay, is the elusive 3 or maybe even 4 sigma kind of moves. Those are just wild, outlandish moves. Those are moves when I say, hey, we're supposed to move $33. We don't move 33. We move 100. And that's why, again, this weekend, this is all about, okay, determining what you want, okay, your positions to look like. And again, not necessarily just next week. When I talk about like next week's positions, we can look once again at expected move butterflies, right? The earnings butterflies, which once again, in the past 2 weeks, our butterfly track record has been phenomenal. We're hitting like 50% of the butterflies around earnings. I'll show you again. We did 6 butterflies this past week, and we hit 3 out of the 6 butterflies. But again, let's look past 1 week, which those butterflies are predominantly non-directional when pooled together. Let's look past that. Let's actually aggregate risk and let's make the determination. Should you hedge? Should you hold? Should you fold? What do you want your position to look like, okay, a few weeks or even a few months out? With that, let's get down to some of the charts, some of the trade ideas, and really some of the opportunities that present themselves, okay, in really the days, months, and possibly even years to come. All right, to the charts and trades we go. Sticking to this weekend's theme, a market at highs, hedge, hold, or fold. One of the first points that I was making kind of in this weekend's update was about that transition back to volatility. So historical volatility doubles, and that's over the last 5 days. Allow me to display specifically that. So you're looking here at the SPX, which I often call the mother of all products. And the SPX, just representative of the S&P 500. I'm going to go ahead and turn off all the expected moves. And what I wanted to zoom into and highlight is the type of price action that we're seeing, again, in this most recent week. Again, you almost have to redefine what you term volatility. But I made a pretty bold statement, and that was, volatility doubled. Yeah, historical volatility, which was sitting all the way down here, literally took off to the upside. And that's over a 5-day average. And that historical volatility, again, earlier in this week was at, about 0.039, which is effectively 3.9% historical volatility. It ended, and if you want to take a very detailed look, it ended right here, just shy of about 8%. So again, historical volatility, actual price movement effectively doubles within the last 5-day window. And again, this historical volatility, it is backward looking, but at the exact same time as that volatility, the historical volatility went up, the implied volatility, which denotes options, right? The option volatility, it contracted. I mean, next week, we've got volatility down all the way to the tune of about 8.74%. Listen, I don't want to geek out too much on that front, but I am going to state, for those of you that do understand this, I will not be selling premium in and over the next 7 days in an 8.7% implied volatility environment where I just saw, the implied volatility, again, contract over the last couple of weeks, but historical volatility is on the rise. That's not going to happen for me. So with that, let me snap back and out of it. Okay, we'll zoom all the way out. We're actually going to put our expected moves back on. We'll have another glance at those expected moves here in just a few minutes. All right, the next thing I want to talk about is, new highs. Let's for this bring up the spiders a little bit cleaner. New highs in the spiders. Bring up a longer duration chart over the last 5 years, of course. New highs inside of the spiders. From the spiders, we jump over to the QQQ. New highs inside of the Qs. Then we jump over to the lovely IWM. Nowhere near new highs. Just wanted to point out that there is, a little bit of a dissension in the ranks, if you will, amongst the major index products, and specifically as it relates to the IWM, which is the Russell. This thing is absolutely trapped in a range. Nevertheless, this could actually be one of the more opportunistic, if you would believe, that the S&Ps, and let me just set scenario for you. If you believe that the S&Ps are likely to continue to go higher, the IWM, specifically the Russell, would have to and should play catch up to the upside. So there is a trade opportunity in there. There's one other major opportunity that exists on this particular front, and that's the relationship between the IWM, for example, and the QQQ, something I've talked about extensively. There's a pairs kind of relationship in here where if you wanted to get long the IWM, that means own the IWM, and for instance, short the QQQ, now is likely a very good time to do so because, again, if the IWM is going to break to the upside, phenomenal. The QQQ is a little weak on a relative basis. What I'm saying is that the Nasdaq has been a little weak relative to the Russell, and the Nasdaq is a little bit weak relative to even the S&Ps, in some of the more recent trade. Again, what I just covered in those last two little bits over there, transition back to volatility and really index comparisons. Listen, that's up the learning curve. It's up the food chain a little bit. So please bear with me for a moment. We'll get into the context of this marketplace in a much more substantial way. Well, right here, right now. Next, we've got our earnings butterfly update. So we hit some flies. Facebook, Altria Group. We hit a nice fly in Altria Group and hit the AIG fly today. You had to be quick to the trigger, though, to get out of the AIG fly. that was an easy one to get out for break even, to hit some degrees of profitability. But you got to realize we only did 6 butterflies. And these butterflies, they ranged anywhere from a probability of about 8% on up to about 17%. Yet we had a 50% hit rate. We blew out butterflies in Apple, Starbucks, and Alibaba. Who cares? Let them go. Okay. The butterflies around earnings expected moves thus far, and again, kind of tracking this over the last couple of weeks here. These butterflies have been an absolute home run for us. And again, we're starting to track all the individual trades here at TheoTrade when it pertains to especially these earnings-based butterflies. All right, onward and upward. By the way, we'll be looking for more earnings-based butterflies in the next week. Yeah, earnings are not as exciting, all right? You're through Apple, you're through the Googles, you're through the Amazons, but it doesn't make a difference. These are earnings butterflies. Did I care that I hit, an Altria Group Mo? No, nobody's like, it's a smoking stock. Yeah, well, guess what? I hit a butterfly on that. Works for me. I don't like Facebook very much either, but I hit a butterfly there. Somehow I think Facebook is probably worse for your health than smoking. All right, and AIG, don't worry. They almost took down the U.S. economy, but I hit a butterfly in it. All right, onward and upward. Implied volatility remains elevated in the back months. So for a second again, I got to geek out on you. Come on. We're at near all-time highs, and the opportunities, they're growing. You just have to kind of know where to look for them. So the first statement, my, what a large contango you have. All right, some people have no clue what contango or backwardation happen to be. You know what? I think the better way to actually describe contango or backwardation, I'm actually going to cruise over to the spiders. You're going to cruise to the spiders, and I'm going to explain you something here in the spiders. Okay, I'm going to highlight on the right-hand side of the screen here on thinkorswim over here. Those are the implied volatilities, right? And when I'm talking about, a contango or a backwardation, what I'm saying about implied volatility is in the very near-term options, in the very near term, like, look, this is 5 days, this is 7 days. Let's just go 7 days out. Look, that implied vol, it's like 9%. But then as you go out in time, forget about like 30 days. 30 days is right around the VIX. And the VIX is trading right around that 12 region. 12 is the VIX. But if you go a little bit further out in time, those volatilities are still relatively high. So what that effectively is, it's a very, steep volatility skew. So I know a lot of people, they're going to email me, and they are emailing me right now and asking me in the chat room. They're like, can you do some of those trades that you do in the VIX? And I'll start to look for them, but you have to realize that the VIX, okay, it's the 30-day implied volatility of the SPX. But what people are missing is that the VIX, okay, in the future is already pricing a lot more risk. What do you mean the VIX in the future? Listen, the VIX options are not pricing off of the VIX, right? The VIX options, and this is the most confusing thing for people, because December options in the VIX that are 46 days out, they're not pricing off of 12/30. Okay, the December options in the VIX are actually pricing, okay, off of this little guy right here. This little guy right here are the volatility futures, and you're like, what? Look, the DEES volatility futures are already pricing the VIX at 16.17. So when you try to place trades in the VIX, you're not really trading the VIX. When you try to place trades in the VIX, you're really trading the volatility futures. These are like options on volatility futures. So when you think that the VIX is really at 12, the December options in the VIX are already trading as if this thing was trading at 16. And you can see it because, for those of you, again, that are geeks, you can see what's called put-call parity. And the put-call parity exists right around the 16 strike over here. All right, onward and upward from there. I know that one's going to leave you, in stitches, I tell you, but don't think that those trades are just sitting out there, okay? The market right now, because the theme of this entire weekend is, hedge, hold, or fold. Well, I'm going to tell you right now, the professional trading community still sees drastic risks on the horizon. Otherwise, when you looked at the spiders, okay, and the perfect example here, look at the spiders and go out, for instance, 112 days, the volatility is still, it's like 16%. It's 15% out here. They're just pricing in a lot more risk into the future because they should. right? The future is unknown, but this volatility is steep. It's still relatively steep out there. All right. Onward and upward, implied volatility remains elevated in the back months. All right. Bond volatility. It's back, baby. Bond volatility is back. But the financials, they just fail to listen. When I'm talking about bond volatility, specifically, I'm looking at the ZB, I'm looking at the ZN, and I'm looking at the TLT because I've got positions on pretty much all of them. So in the last, last couple of weeks, well, look, we kind of meandered a little bit lower in some recent trade, nothing too big. All of a sudden, though, this week it was down, it was up, it was all over the place. So that bond volatility really picked up in a big, big way. And you can see the volume is back in there as well. Now, the reason I'm pointing this out, yeah, the bonds, generally speaking, headed a lot higher, okay? And as the bonds go higher, it takes the TNX, which is the interest rate, and shoves it down. So the interest rate's going back down. Now, that should impede upon the financials. The financials, though, do they look like they were impeded upon? I told you this is going to be a big week in the financials, okay? It is going to be a big week inside of the financials. And I just want to point out, yes, okay, I'll fix that, okay? I'm still a contrarian in the banks, okay? And I have a love-hate relationship with the XHB. I'm going to get to that in just a minute. But I am still absolutely unequivocally short inside of the financials. And I told you guys, this may not pay off, okay, in the next day, the next week. This one will eventually pay off. You have to recognize that we're in an environment that should stress, okay, the banks. Now, granted, the Fed is and has lowered rates. As the Fed lowered rates, it's actually maybe steepening the yield curve a little bit, but the yield curve is pretty much totally flat right now. You would think, okay, that this would impede upon the banks. It has not as of yet. Okay, the financials remain the object of my affection, and their volatility is substantially higher than you are seeing in the rest of the marketplace. In fact, a great kind of way to compare and contrast over here, take a look at the financials, which are sitting at 15% volatility in the next 7 days, okay? And compare that to the S&P 500 over the next 7 days, which is sitting closer to 9%. The financials, okay, have substantial volatility above and beyond most major, okay, sectors inside of the S&P 500. So once again, I will reiterate, financials right now, they are actually running this thing. Okay, it's not tech. Everybody's, focused on tech. Look, all right, today, the monsters of tech underperformed the financials, and that's the way it's effectively been the last couple of trading sessions. All eyes got to be on the financials. I am absolutely still a contrarian in there. As I was also saying, I have a love-hate relationship with XHB. XHB, okay? The more the Fed says we're going to cut rates, the more the XHB, this is the home builders love it. I'm also maintaining short positions inside the XHB. The positions both in the XLF and XHB, though, happen to effectively be duration positions, meaning that I don't necessarily think that this thing is going to cave the XHB tomorrow, but I will make this argument all day and all night long, and that's this. The risk reward inside something like the XHB could be phenomenal. And that just means, like, look at the upside potential versus some of the downside risks. And I love it. And I'm willing to take some short-term heat, okay, for some long-term profitability. And that's me. That's my directional bias. That's the trader in me. And I am not afraid, okay, to take a little bit of loss and a little bit of pain in the near term to actually come out of the other end of that one. All right, so that's a little bit about my love-hate relationship with the XHB. Listen, I love to hate it. All right, love to hate it out there. Next, Lagarde in charge. It sounds like a bad episode of Charles in Charge, and it very well might turn out to be. The reason I threw this in here, so the changing of the guard has effectively happened at the ECB, the European Central Bank. Mario Draghi, Super Mario, is gone, and now we have Christine Lagarde. Forget the fact that she was possibly, involved in something criminal a while ago. Don't worry about any of that. By the way, you can't make that stuff up. Be sure to Google that name. Anyway, Christine Lagarde comes over from the IMF. She's now in charge of the ECB. And if you're unaware of this is going to get interesting because the ECB, it's the most divided they've ever been. At least the most divided they've ever been publicly. I'll throw that one out there. So I don't know about you, but I'm excited about the project. All right, next, the Fed. The Fed came out this week. They saw their shadow, 6 more weeks of winter. Now they cut interest rates, but the Fed says no more. Okay. Does the market actually believe them? That's actually a great question. Does the market believe them? There's only one way to answer that. Here's the market. So when I say the market, first of all, the December, this is where the Fed fund futures rates currently are, and I'll highlight this a little bit better. That's where Fed fund futures rates currently are. Right now, there's an 87% chance that we keep them the same in December. But when you go a little further out in time, out to the January meeting, all of a sudden there's only a 64% chance of them actually keeping the rates. There's even about a 32% chance of a 25 basis point cut. Even a 3% chance of a 50 basis point cut. When you go out to the March meeting, is a 50-50 shot. So all I'm getting to, in December, the market says they're done. In December, okay, at the next Fed meeting, they're not going to cut rates. Further out in time, the market actually believes they are going to cut rates. So much for what the Fed says, because apparently the market does not believe them. When you just look 3-4 months out, they're saying 50-50 shot already. All right. Next, kind of a little nest segment over here, Stock Chop. We're going to quickly look at a handful of stocks. One of those being Costco. I'm maintaining short positions inside of Costco. Why? Effective risk reward in here. Starbucks. Okay. I am continuing to maintain the short position inside of Starbucks. This one is finally paying off in a big way. Okay, Cisco, I'm going to reiterate, I've maintained my short position inside of Cisco for a considerable period of time. The short position inside of Cisco, listen, I'm very close to actually exiting this. That's why I wanted to bring it up. Lulu, okay, Lululemon. Here's one that just recently turned, okay, and things could look a lot better, but I'm maintaining, again, the short position inside of Lulu. And last but not least, okay, XLV. Each one of the trades I'm actually bringing up here are specifically, these are my short positions. These are some of the larger short positions. Do I maintain long positions? Absolutely, unequivocally, yes. I carry long positions right now. Tune in at any time into TheoTrade and you'll actually see some of the long positions. But these specifically, I wanted to cover them because they fit very nicely into this idea of hedge, hold, or fold. You know, when you're looking at a marketplace at all-time highs and the marketplace is literally burst to the upside, okay, it's okay to be short. It's okay to be short, especially when you look at something like what? XLV, which could have had a key reversal today. If you look at Lulu, had a down day. Well, the reason I brought up these individual products, and again, each one of these I carry positions in. The reason I'm bringing those up, those products did not fare well in a day where the market actually hit all-time highs. All right, onward and upward to the SPX. When I get to the SPX, you'll note I mentioned, okay, in last week's video that the SPX had an incredibly high probability of touching or even exceeding the expected move. We hit it. We hit it smack on. We closed a hair outside of the expected move. I mean, it's so close. Okay, we're splitting hairs over here. Listen, this is a $3,000 product that missed its target by less than 10 points. Now, the reason I'm concerned about the SPX specifically, and I really want to hammer this home to you, you just saw the SPX exceed what it was supposed to do. And in the next week of trade, they've actually contracted the volatility. Look, okay, the numbers are right here. Last week, there was a $33.42 expected move. Next week, okay, $31.17. Why am I concerned? Because last week, we moved more than $33. And next week, we're only supposed to move 31. I'm sorry, we're transitioning and continue to transition back to more volatility. Okay, this is a premium buyer's marketplace. Don't get caught selling premium. Finally, okay, we finish with hedge, hold, or fold. Throughout the course of this next week, okay, here at TheoTrade, I am going to be displaying on Monday, Tuesday, and Wednesday different ways, okay, that you as a trader and or as an investor, you got a 401k, you got an IRA, you got funds, can mitigate your risks. We're going to dissect things like the atomic hedge. We're going to look at risk twist spreads. Okay. We're going to look at VIX volatility spreads, all of the above. We'll even look at the idea of delta hedging. Why not? Commissions on stock are free right now. People, you really need to consider, what do you want your positions to look like? Okay. to the near future, a couple of weeks out, couple of months out, again, even a few years out in time. With that, thanks everybody for joining us here at TheoTrade for the weekend update. Have a wonderful weekend. Bye-bye.